Hello, everyone, and welcome again. I've got a short video for you concerning Chapter 2 in Accounting 120, Financial Accounting. I'm going to share my screen shortly, but before I do, I just want to emphasize that Chapter 2 is probably the most important chapter in the book for this course. It covers a lot of material. So I'm going to share my screen to go over one of the very basic items covered in Chapter 2. First of all, I'll scroll down in a second, but what I wanted to look at today was the structure and the use of what we call a T account in accounting. Now, you may notice on the screen, this is an example of a generic T account. And as you can tell, it's pretty self-explanatory. It looks like a great big capital T. That's a good way to remember it. The basic structure is you put the name of the account on the top line. So, for example, cash or equipment or accounts payable or revenue. And then below there, you have a left side and a right side. The first rule to always remember is you always debit on the left and you credit on the right. That will be the case every time, no matter what problem you're working on from now until the end of the course and beyond. You debit on the left and you credit on the right. So that is the basic structure of a T account. Now I'm going to scroll down and show you an example of a T account being used. So you already should know or have read that accounting is a double entry system. So you always have two entries per transaction. So let's just assume, just a general example, that you have $20,000 that you sold a 1-year premium for a subscription, and your client that you sold it to paid cash. Okay, so there's going to be, again, double entry. You've got two things going on. So the two accounts that are involved in your business are cash, which is an asset, and revenue, which actually comes under owner's equity or retained earnings. Remember, cash, think of it this way. That's your bank account for the business. Where do you put your money? You put it in your cash account. What is revenue? Revenue is the money that's generated through sales of your product or service. So it's the money that you bring in from actually doing work or selling a product or service. So those are the two accounts that are affected. I'm going to scroll down in just a second. And here is an example of how you would actually analyze that transaction and account for it. You have obviously two T accounts for this transaction. Double entry, you're going to have two every time. Remember, debit on the left, credit on the right every time. So if you go by the rules of debit and credit, the $20,000, which goes into your cash account and your revenue account, if an asset account increases, which is cash, that's going to be a debit. If the revenue account or income goes up or increases, again, that's under owner's equity. But if a revenue account increases, that is a credit to that account. So one debit, one credit. And that's it. Okay. You have to keep up with a few different things at the same time. In particular, the rules of debit and credit. If you can keep those straight, then I think you'll be successful. And again, as I said at the beginning, Chapter 2 is incredibly important. Chapter 2 gives you the basis for everything for the rest of the course. So it's really important to get a handle on Chapter 2. So I'm going to stop sharing my screen. There we go. So again, that's just a very short video on the structure and the use of T accounts and the use of debits and credits. If you have any questions, any concerns, please send me an email or a call or text. I check it every day as usual. And until next time, thanks again and good luck.